Hey Dave, how you doing today?
I'm doing great, Nick. How are you?
I am doing well, but I'm a little bit blown away that it is already the 20th of October, and we are talking
Yeah,
about the what happened in the third quarter of 2025. So I guess here we
faster
are,
and
right?
faster every quarter. Yeah. Here we are. Year is three-quarters of the way through, and it's been quite the year. Very interesting times.
A bright, sunny fall day out. So there's
Yeah.
worse things to be
Well,
weather-wise in Michigan this time of year.
th-
So we have
there's
that to be
worse
thankful for.
worse things to be talking about than third quarter 2025 market returns.
That is very true, and I don't know how
Yeah.
you feel about this, Dave, but it's for whatever reason this year more than any other year. It just seems like there is so much going on in the news that is negative, and the market is just like, well, we don't care about any of
Right,
that. like,
right, right. Like the what's that? There was a comedian a couple of years ago who was famous for the line like everything's great and everyone's miserable all at once.
yeah,
kind of
yeah.
kind of feel like that's where we're at least in terms of the market. And I think
Oh yeah,
the point you're getting at is we've all got things we're thinking about and worried about one way or the other,
yeah,
economically, politically, but the market just doesn't seem to care right now.
yeah. Which is like usually in a lot of markets the stock market just is very irrational and hangs on every note of good and bad news, and it just
Hmm.
seems like the stock market is just not doing that, which is rather interesting to me. So
Yeah.
with that being said, let's dig into the third quarter review here, and our friends from East Bay are always kind enough to put this together for us, but we have our balanced approach at looking at these things with our glass half full, glass half empty. And kind of what we alluded to on the half full side is global stock markets continued their upward climb in the third quarter.
Yeah, we've just seen, well, essentially every sector, well, every broad asset class and category of the stock and bond markets were positive for the quarter, with the exception of U.S. REITs and
Yeah,
global REITs, which includes U.S. REITs, were down slightly. Non-U.S. REITs were very positive, along with the stock market, the bond market. It's pretty impressive how the market is hung in there. U.S. large cap up 8% for the quarter, up 17, almost 18% for the year. Um, Small cap stocks 12.4% for the quarter.
mm-hmm, mm-hmm.
You know, it's and international. 16% for the year for international large cap stocks. Emerging markets up 17%. We
Yeah.
can go on down the list. And at the same time, we're seeing very robust returns by bond standards as well, with
Oh yeah.
positive returns across the board, with interest rates going down a little bit. But the U.S. aggregate bond index was up 2% for the quarter and almost 3% for the year in price, and um, that's a good year.
Yeah, as they used to say on my favorite show, The A Team, I love it when a plan comes together,
Right?
right?
Just like we drew it up. Yeah. So the 60/40 portfolio is not dead this quarter.
yeah.
It is thriving.
Firing on all cylinders.
Right. The media is not pointing that out, but I wish I had written this down. But the return on, oh, actually, I have it here. Just a minute. The return on a 60/40 portfolio is um, only a couple points shy of like the pure S&P 500. 12.6% as of the end of the quarter. Year to date portfolio
yeah.
comprised of 60% global stocks and 40% the aggregate bond, which trailed the S&P 500 by only 2.2% with much less risk.
Yeah.
So that's an interesting position.
It's been a great year for international stocks for sure.
Hmm.
Um, and it's kind of one of those things. I don't remember. I hope I made this prediction, but because I made it for like 5 years in a row and it's been wrong.
I
But
was just talking to Cole about this last week, that how we had for years, as part of our crazy prediction episode in
yeah,
January, one or the other of us had proclaimed it was going to be the year of international. And I
right.
can't remember if this January we both like threw in the towel and we're like, well, we're not making that dumb mistake.
Yeah.
Which would be like the most like bad prediction episode prediction of all time. And right, very on brand for our for that episode.
Too true. Too
Yeah.
true. It just goes to show you how hard these things are to predict,
Yep.
if
Yep.
nothing else, right?
Yep.
But I
Yep.
think, overall, there's been, we have done a lot of review meetings with clients. And I think everybody's kind of feeling surprised at how
Yeah.
well their portfolios have done.
Yeah. Yeah. Well, that's been a theme going back to the middle of, at least the middle of last year.
Yeah.
Um, I have to check to see, in notes when that started to be kind of a prevailing theme. But yeah, like upbeat surprise in
Right.
terms of how
Yeah.
the portfolios have performed, in terms of, again, contrasting that to the general mood. And I always think of the old cliche, a bull market climbs a wall of worry, and
Yeah.
doesn't, with the corollary being that when you don't have anything left to worry about, everybody's last dollar is in the market and there's nowhere for it to go but down.
Yeah. Right. There you
So,
go.
um, so yeah, the contrarian, and I know you feel this way in general too, is as long as people are not happy and finding things to be worried about, then there's still
Right.
potential upside to the market.
Yeah. Very true. The second point on our chart here is the near-term recession risk continue to fade in the U.S. And this has been an
Yeah.
ongoing, like 3 or 4, like the next recession is coming, kind of
Yes.
thing. It's like the 3-year recession that never happened,
Yeah.
basically.
Yeah. Yeah.
And we're seeing, very a lot of resilience in economic growth. Some pretty big numbers from the second quarter,
Yeah.
with similar projections for the third quarter in terms of our real GDP numbers. So the second quarter was 3.8%. I believe the third quarter should be somewhere. The economists that paid a lot of money for this kind of stuff are saying it should be similar to
Right.
the second quarter.
Right. Right. It hasn't officially been announced yet for third quarter, but every indication is it's going to come in fairly strong.
Yeah,
And,
and kind of a big chunk of that right now is consumption. Consumers are still buying
yeah.
stuff.
Yeah.
Despite what's on the evening news, we're still out there spending money, and we still feel good about that.
That's right.
And so, yeah, and it's been interesting. Tariffs have played somewhat of a role in that, with net
Hmm.
exports actually being quite robust in the second quarter. And part of that was just the fact that they were so negative, or they were negative in the first quarter, because everybody was kind of front running the tariffs. And so
Yes.
we'll see how that plays into it long term, but we're expecting another good number for the third quarter as far as GDP goes.
Right. And the last point on our positive side of the ledger is that the Federal Reserve did just recently lower interest rates in September,
Yeah,
stimulating the economy potentially.
yeah,
Um, and the old adage, "Don't fight the Fed."
right.
The Fed's going to lower interest rates. It's usually good for the markets. So we will stay tuned to see how that plays out. But we're not gonna stand in its way.
Yeah, it's an interesting one, because the reason why they did it, which is the first point in our glass half empty, is the labor markets are showing signs of softening.
Hmm.
But it just, we say this all the time. It feels a little bit different, but that doesn't necessarily mean it will be.
Yeah,
But it's the Fed's kind of in a rough spot right now.
they are, and we've done whole episodes on the dual mandate of the Fed, and trying to thread the needle between keeping inflation under control and otherwise not letting growth get out of hand, and at the same time, supporting the labor market, which requires growth. So finding that right balance is tricky. To me, it seems like they're putting up a pretty good front here with they're out ahead, like the labor labor markets are showing signs of weakening. We did not create nearly as many jobs last year as expected, or as anticipated based on earlier reporting. Um, Anecdotally, it seems like it's a tough job market too. So it seems like maybe before things get bad, they're being proactive there, and inflation isn't as low as they would prefer. It's 2.9% when they would prefer to see it at 2%. Um, but I guess one thing that ever since 2022, when they raised rates precipitously to head off inflation or to recover from inflation, it's like now we've got room, right? They
Right.
can raise rates if inflation gets out of control again, starts to show. They can lower rates if the economy needs um, stimulus. We're not like sitting with our foot already on the floor as far as the gas pedal of interest rates goes. So,
Yeah, I think that's a great point that we kind of forget sometimes of like if they're at extreme lows or extreme highs, they only have one option,
right,
right?
right. Yeah, this is like cruising down the highway at 55 miles an hour, and you can speed up to pass, or you can slow down
Right.
to stay in line. I like that better than the extremes, anyway.
Yeah, and we've talked about this before. They've taken a cautious approach to a lot of this stuff, which we kind of applaud, despite all of the outside pressures.
Yeah, now more than ever, it's been a little bit of a joke a few times over the last year. The Fed has felt they needed to come out and say they were data driven, right? Our
Yeah,
decision
right,
will be data driven instead of like a foregone conclusion of what we're going to do. Well,
right.
duh, right? I mean, we hope.
Yeah,
So, we're kind of in a better place than we have been over the last several years. Most of our careers, it was like interest rates from one extreme or the other. So,
yeah,
um, I like this better.
yeah. And they've stuck in. Is that a word? I'm not sure about that.
Sure,
they've they've
we'll allow
stuck
it.
to their guns as far as if you look at the path that they had projected as far as a
Yeah,
rate cut, it's not like, okay, we're in a rate cutting cycle, we're just going to start sliding. Like,
yeah,
they knew coming in, if we
yeah,
got to this point, it would be kind of a we're not going one direction or the other too fast too quickly
yeah.
kind of thing.
There is still the idea that, in general, the tariffs should be inflationary.
Yeah,
And, it's not showing up yet, but that doesn't mean it won't. And, being able to turn around and raise rates again if they need to is
right.
where we should be.
So this next point is one that we've kind of touched on before, but I think it's coming a little bit more in the limelight, especially lately. But that is AI related spending is robust,
Hmm.
but there's uncertainty around future revenue streams, right?
Yeah. And so we've seen this, precipitous run up in the stock market related to AI growth and the productivity it may unlock. But now it's like, now we got to start seeing the results. We've been saying that, I think, for a couple quarters now with regard to the AI stocks in the market. Um, I find, we talked about this earlier today as a team, that everybody's kind of everybody. By everybody in this sense, I mean like media outlets, pundits that we listen to on podcasts. Is AI in a bubble? When does this bubble pop? Clients are asking that. I got that question twice last week from clients. Like, this has to be a bubble. Well, part of me wants to say, and of course, never say never, and I don't know anything, but as long as people are worried that something's a bubble, is it really a bubble? So contrasting this to early in my career, like I started in 2000, right when the tech bubble was popping. Everybody just believed that all the internet stocks were going to figure it out,
Yeah,
and that there was no talk of it being a bubble at the time until well, you know, digging back through the archives of my history may not be the best way to say no one was talking about it, but there definitely wasn't like a perception of there
right.
be, like, okay. and there was the famous Alan Greenspan, chairman of the Federal Reserve at the time, talked about irrational exuberance in the stock market, and I've always associated that with the beginning of the end. But it turns out that he actually made that comment in like 1996.
Hmm, interesting.
Yeah. So the point being, everybody's kind of conscious of the fact that maybe those stocks are in a bubble. So then maybe they're not in a bubble, or when it unwinds, is it going to unwind in this horrible way? There's no prediction around that. But longer term, we've talked about this with clients lately too. The if we want to extend the tech bubble comparison, internet commerce really did change the world for the better in terms of productivity and what it meant to the broad economy. It may not have been pets.com and MCI WorldCom that benefited from it, but Procter and Gamble and Amazon and all these
Hmm,
mainstream companies all figured out how to be more profitable, and their stocks are much better off today than they would have
yeah,
been 25 years ago, just because of internet commerce, and they didn't necessarily have .com behind their name.
yeah.
So,
Well, I think that's an interesting point because, I do believe that AI will be somewhat transformative. To what
mhm,
degree, I don't know.
mhm,
And that's part of the problem, right? Like trying to predict, yeah, so Oracle's going to go out and spend billions of dollars over the next couple of years. Do I know that that's going to make them a better, stronger
right,
company?
right,
No.
right,
But they're pricing it in that way right now too. And that's the other part of the problem is once you make those announcements and you see that jump up in price, the only way to keep that price high is for the earnings to eventually come,
right,
right? Otherwise, you have this out of whack where they're not making money on it, but everybody, people will
right,
stop believing that it's worth that price if they're
right.
not if the revenue doesn't come, right?
Right, right. The emperor will have no clothes at some point.
Yeah, it's one of those things. Like in time, we'll probably look back like we do on the internet and say, yeah, that was kind of a no
Mhm.
brainer. But that doesn't mean that every company's going to get it right, and there's going to be some shakeup for sure.
Yeah, they can't all. I don't know. It seems improbable that they can all sustain the kind of expectations that are built into their stock prices right now.
Right? Yeah.
So there'll be winners, there'll be losers. One example just from our own. So you and I just got back from a conference. How many different AI options for our business are out there right now?
Yeah.
10?
At least.
I think between us we could probably name 10 anyway.
Yeah.
And they all do, like from my point of view as a potential consumer of those products, they all seem to do pretty much the same thing, right?
Right.
They
Yeah.
can't all be, they're not all going to be here in 10 years. There's just
Right.
no way.
Yeah.
I mean, look at the auto industry in like 1920 versus
Mm-hmm.
1950, versus today, in terms of like the number of brands and names that were out there. Um, there will be consolidation. There will be survival of the fittest, and that's good for us ultimately as consumers. But it's another reason why we're not trying to pick individual stocks or back who the winners of these races are going to be.
Yeah. Well, and to your point, last year when we went, there was one or two,
Right, right. And now it was like every other booth at the
and
exhibition
every
was,
company all of a sudden has AI in their products. Like,
yeah,
I don't know if
yeah.
it's really AI or not, but that's what they're calling it because that's the buzzword, right?
Yeah. Well, and interestingly, the SEC in audits this year is scouring advisors' um, marketing materials for mentions of AI and then making them prove it. Like if you and I, and we're not doing this, SEC, if you and I were talking about how our investment process is AI driven, blah 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 blah, we'd have to we'd have to be able to prove it to the SEC because it's become such a marketing buzzword. I thought that was kind of
Yeah.
interesting.
To be determined, right? And
Yeah,
that, like you said,
yeah,
that's the benefit of diversification of owning
right.
small companies, of owning the S&P 500. I
Well,
guarantee you we're going to own the winners of that. We're just also going to own the losers, but it'll balance out.
and another thing that's been interesting, and this, so there was an article in the Wall Street Journal today talking about how, like, over the last week or two, there's been a lot of rotation into so-called defensive stocks.
Yeah.
Not defense companies, but defensive in terms of market volatility, away from tech and AI and stocks that don't do very well during economic downturns.
Hmm.
And interesting to that point, it's not going out of the market. It's just going into different parts of the market, which is still
Yeah.
net positive if you're a diversified investor.
Right.
And we believe in diversification, not picking individual stocks. And we're going to benefit from that as long as that money's staying in the market and
Right.
and
Yeah.
moving around from bucket to bucket doesn't bother me.
Yeah.
It's to be expected. That's ultimately, why we're not playing particular sectors, playing particular parts of the market. I looked at the statistics a week or two ago on our like basic 60/40 portfolio, and I think NVIDIA was just slightly more than 1%,
Yeah. Okay.
you know, as far as the holdings go. So, all right, that's enough about that though.
So let's look at the Q3 2025 by the numbers for.
We had one more point on the glass half empty.
Ah. Oh, how could I forget?
Yes, we're in the middle of a government shutdown, which always creates economic uncertainty, right?
Yeah. Oh, by the way, the government is shut down.
Yeah, and I just remembered that I told you we'd probably cover that at the end, and that's probably why you
That's all
you
right.
were
We'll
skipping it.
circle back to it for sure because we do have some charts on how government
Yeah.
shutdown has affected things previously, because this is not the first time, nor will it be the last. But in our Q3 numbers, 4 to 4.25 is the current policy target range for the Fed funds rate set by the Federal Reserve. 211 billion is the cumulative amount of capital estimated to have been spent on AI projects
It's
by the
crazy.
end of last year, if you can believe that.
Yeah.
And then 0.11 is the average S&P 500 performance during federal government shutdowns. So
Yes.
not slightly positive,
Slightly
but certainly
positive, but not negative.
negative.
Yeah.
Yeah. And then we covered this as well. 12.6 is the year-to-date return for a 60/40 portfolio.
Yeah.
So just touching on the government shutdowns going back in history, the last one was actually December 22nd of 2018. And the market responded quite positively to the government not being open,
that
about 10% during that short window.
Yeah, it's the biggest monetary endorsement of the policy of the best government is that which governs least.
Yeah.
Um, when the,
So, but we've definitely had, throughout time, this chart, we'll post this chart in the show notes, goes back to 1976. We've had some good years, we've had some bad years, but pretty much a mixed bag and nothing crazy. Like we
yeah,
don't see any huge gains, huge drops because of it. It's kind of a mixed bag, if you will.
yeah, and looking at when a few of the like there was a -5% when the government was closed in the fall of 1979, but there was a lot going on in the fall. I'd like to see. I mean, I was quite young at the time, but 1979 has always struck me as a year, between inflation and terrorist troubles and different things
Yeah,
going on. Was the market downturn coincidental to the government shutdown, or was it caused by the government
right.
shutdown? Is really hard to parse when we look back at these historic things. But what I think in terms of like what does a government shutdown mean for the markets, the one key thing is that usually they don't last all that long, right?
Right. Mm-hmm.
And it takes a while for a government shutdown, to potentially impinge on the economy in terms of payments not being made, workers being furloughed. You know, it takes a while for that to show up. So,
Yeah, it is. To your point, it is interesting, like how much of this is due to just where we were and how the economy was
mhm.
doing, and how much of it is due to the actual government shutdown. But this one seems to be. I'm sure they all kind of seem to be, but seems to be like it might drag on for a while, just given the time
Yeah,
and where the parties are at.
yeah,
But eventually that will impact GDP numbers, things like that for sure.
Yes.
But again, and with all of this stuff, like this is a great way, and the reason we do this is so that people kind of know what's going on and what to expect.
Right.
But this is all short term, right? Like there's a reason we're long term investors. There's a reason why your financial plan is created based on long term assumptions, and we always assume that when we create a financial plan, there's going to be some downturns, there's going to be some bad markets, so that we're prepared for that. And that's just this another great example of we have no idea what's going to happen tomorrow, next week, next month, next year in terms of market returns, but we've got a pretty good understanding of how your portfolio and your plan should work over longer periods of time. And that's really what we have to focus on.
Absolutely.
So, with that, Dave, it's been a pleasure as always. If you want more information about our investment philosophy or the markets, feel free to check us out at www.srbadvisors.com. Thanks, Dave.
Thanks, Nick.
Thank you for joining us for another chat about your retirement and finances. Please hit that subscribe button. You can also contact us at srbadvisors.com or email us at info@srbadvisors.com. See you next time on Kitchen Table Finance.
This is a Cedia Media production.